Common mistakes of beginners. Most newcomers to the financial markets tend to focus on finding a magic method to make quick money. They get drawn in by flashy images and high profits, believing that success lies in some secret tool. As a result, they fall into a cycle of learning, trying, quitting without going deep or truly maturing. Some manage to stick with a stable method but still fail due to poor psychological control, driven by greed, fear, and ego. They take oversized trades, hold on to losing positions, overtrade, and eventually blow up their accounts. The core issue isn't the method, it's within each individual. Trading is a profession that demands self-awareness, emotional mastery, and psychological control. Only when you conquer yourself can you hope to conquer the market. The root of success lies within. The foundation of success in trading doesn't lie in the market, it begins with the trader. Trading is not just a battle against price fluctuations but a long journey of overcoming one's own emotions, ego, and bad habits. A truly successful trader is not someone who wins the most trades, but someone who can maintain self-control, stay clear-headed, and remain disciplined in any situation. Experienced and sustainable traders are often humble and low-profile. They understand that arrogance and overconfidence lead to costly mistakes. It's the overcoming of ego that helps them maintain stability in both mindset and strategy. Therefore, the key is to build from the ground up, starting with the right mindset and forming a trading philosophy that fits your personality. Only by recognizing your central role in every trading outcome can you grow sustainably and achieve true success in the markets. There is no absolutely correct method. In trading, a little-known truth is this: your method accounts for only about 10 to 20% of long-term success. The majority depends on mindset, discipline, and emotional control. No matter how good a method is, it won't generate profits without the discipline to follow rules or the composure to act wisely when the market goes against you. Many traders fail not because their strategy is wrong, but because they can't maintain psychological stability during key moments. They get caught up in emotions, make impulsive decisions, or abandon their plan. Successful trading is the synergy of understanding your method, applying proper risk management, and strengthening your mental resilience. Instead of endlessly searching for the holy grail strategy, traders should invest in building a sound mindset, practicing discipline, and mastering emotional control. These are the real foundations for lasting success in a volatile market. Probabilistic thinking, the core foundation. Probabilistic thinking is the core foundation of financial trading. What matters is not how many trades you win, but how you manage risk and reward in each trade. A trader could win only 40% of the time but still be profitable if their winning trades yield significantly more than their losses. Thus, a reasonable risk-to-reward ratio is key. In a volatile environment, no trade is guaranteed. Going all in just because a trade looks perfect can lead to serious risk. Instead, each trade should be viewed as a small part of a long-term probability series. You must maintain discipline, follow your strategy, and apply strict risk management to ensure sustainable profits over time. In summary, probabilistic thinking helps you break free from the win-lose mindset of individual trades and shift to a more professional approach, optimizing long-term profits through patience, discipline, and a clear understanding of probability in trading. The formula for consistent profits. To achieve consistent trading profits, don't focus solely on finding big winners or trying to win every trade. The secret lies in a simple but powerful formula: win rate combined with risk-reward ratio, essentially your expected return divided by potential risk. What matters is not how many trades you win, but the average value your overall system delivers. A few large wins can't rescue a poor strategy in the long run. On the other hand, a stable system with clear rules and strong risk management is the true foundation for sustainable growth. Don't let emotions take control, and don't rely on gut feelings. Instead, build a system based on probability and expected return. That's the path of professional traders. Consistent profits don't come from luck, they come from a system with real edge. Process of building a sustainable trading system. Building a sustainable trading system isn't a one-day task. It's a serious process that requires patience, discipline, and deep self-understanding. First, choose a trading method that suits your personality, time availability, and psychological profile. There's no one-size-fits-all strategy, only strategies that fit you. Next, don't just copy others. Understand the principles behind the method and then customize it to your personal style. Once you've laid the foundation, begin backtesting, running the system through hundreds or thousands of past trades. This helps you identify strengths, weaknesses, and build confidence in your strategy. After collecting enough data, calculate your average win rate and reward-to-risk ratio to evaluate the system's effectiveness. Don't rush into trading with a large account. Start with a small cent account, real market, small capital, to train your psychology, something backtesting can't teach. Finally, if you can trade consistently for 3 months, only then consider scaling up your account. Successful trading doesn't come from rushing, but from laying a strong foundation step by step. This is the path to becoming a sustainable, long-term profitable trader. Failure stems from false expectations. Many traders don't fail because of lack of knowledge or skill, but because they start with false expectations. They expect to get rich quickly, win consistently, find a perfect strategy that never loses, or uncover a shortcut to success. But the truth is, there are no shortcuts in trading. The market doesn't care about your emotions or desires. The right path in trading is slow, requiring patience, discipline, and continuous refinement. It's about building a system with real edge, developing strong mental resilience, and accepting that losses are part of the game. Sustainable success doesn't come from magic formulas, but from maturity gained through experience. When you let go of false expectations, that's when you can truly move forward in your trading journey. Trading is a journey of personal growth. Trading isn't just a financial game, it's a profound journey of self-development. Every click of the mouse reflects your inner greed, impatience, and emotional triggers. The market acts like a mirror, revealing all your psychological weaknesses. In a volatile and uncertain environment, the successful ones are not those who guess the market right, but those who control their emotions, stay disciplined, and follow through with their plans. Trading doesn't teach you how to get rich quick. It teaches you patience, rational thinking, and maturity through every decision. When you build a strong mental foundation, you don't just become a better trader, you become a stronger version of yourself. Psychology is the deciding factor. In trading, psychology is the key factor that determines success or failure. Most trading strategies are quite simple in theory: buy here, sell there, manage risk by ratio. But in practice, it's a different story. When real money is involved and markets are moving, emotions like fear, greed, and regret quickly override rational thinking. What separates a successful trader from the majority isn't some secret method, but the ability to remain disciplined and emotionally controlled. Because trading isn't an emotional game, it's a game of systems, processes, and probabilities. You don't need to be right all the time, just right often enough and committed to a well-tested strategy. Gaining control over your psychology is the biggest leap toward stability and long-term profitability.